In 1929, the stock market was priced at 33 times company earnings. It crashed. Investors lost everything. The Great Depression followed. In the year 2000, the market hit 44 times earnings. It crashed again. $5 trillion vanished. Today, July 2026, that number sits at 42. Only once in recorded financial history has it been higher, and the institution that is supposed to be the calm voice in the room, the Bank of England, is no longer being calm. It is telling the government in formal warnings that the financial system is not ready for what comes next. There is a number that has predicted every major market crash of the last century. It is called the Shiller CAPE ratio. A Nobel Prize-winning economist built it. It ignores quarterly noise and asks a simpler question: what are you actually paying for? The long-term average is 17. Today, American stocks are trading at 42 times their real inflation-adjusted earnings. 2.5 times the historical norm. Let me be precise. At 17 times earnings, every dollar of profit cost you $17. At 42, that same dollar costs you 42. You are paying 2.5 times more for the same thing and hoping someone pays even more tomorrow. History has not been kind to that bet. But here is what makes this different, and worse than every crash that came before it. 7 companies. 7 companies now account for roughly 40% of the total value of the United States stock market. And what do they all sell? Artificial intelligence. The promise that machines will think, create, and replace human labor at a scale never seen before. But something is happening that the stock price does not reflect. Companies are quietly telling their own staff to use AI less because it is too expensive and too unreliable. Bugs in AI-generated software are so widespread that enterprise adoption is slowing. Customer backlash against AI-powered services is growing. The dot-com optimists in 1999 said the same thing. The internet will change everything. And they were right. It did. But not before the Nasdaq collapsed by nearly 80%. Implementation always takes far longer than the price implies. Always. But the stock market crashing is not the real danger. The real danger is what the crash drags down with it. The Bank of England has a term for what keeps senior regulators awake at night. They call it shadow banking. It is the trillion-dollar lending system that exists outside traditional banks, hedge funds, money market funds, private credit, repurchase agreements, and it has lent enormous sums of money against one thing: inflated share prices. If share prices fall, the collateral behind those loans evaporates. Margin calls trigger. Funds are forced to sell into a falling market. The selling accelerates the fall. The fall triggers more margin calls. This is the exact mechanism that turned the 2008 subprime mortgage collapse into a global banking crisis. Only this time, the asset at the center is not American houses, it is the entire US stock market. The Bank of England has formally warned that shadow banking contagion will migrate into mainstream banks, mortgage lenders, business lenders, pension funds. A crash that starts on Wall Street does not stay on Wall Street. But none of this is being prepared for, because nobody in power wants to admit it is coming. In Westminster, the conversation is entirely about growth. The new government is betting everything on an economic expansion that will fund public services, reduce debt, and restore confidence. But the Bank of England's own financial stability reports tell a different story. They describe stretched asset valuations, systemic fragility in non-bank finance, a system, in the careful coded language of central bankers, that is not ready. And now the public itself is pulling back. People are switching off the news, leaving social media, withdrawing from economic participation. Confidence, the invisible fuel of every bull market, is evaporating. You cannot have a stock market priced for eternal optimism in a population that has stopped being optimistic. The CAPE ratio does not tell you the date. It cannot predict the exact week or month that the selling begins. What it tells you is the distance the market must fall to return to historical norms. At 42, that distance is enormous. The last 2 times the market reached these heights, 1929 and 2000, the outcome was identical. A crash of up to 50%. Trillions in lost wealth. and a crisis that reached far beyond the stock exchange floor. Warren Buffett, the most successful investor in modern history, put it simply: we've never had people in a more gambling mood than now. 7 companies, 40% of the market, priced at 42 times earnings, with trillions in shadow banking exposure sitting underneath it all. This is not a prediction. It is arithmetic. If you want to understand what comes next and how to prepare for it, subscribe, because this story is only just beginning.